AI stocks collapse, silver surges, Bitcoin slips. Right now, markets are facing massive shifts with nearly $1 trillion wiped from tech and software stocks, about $285 billion shaken out of the AI sector, and almost $2 trillion erased from the crypto market. And today, we're going to uncover exactly why these losses are happening, why silver is showing strength, and why Bitcoin is struggling during this AI-driven sell-off. Hello, everyone. My name is John, and welcome to the channel where we break down the real forces moving markets beyond the headlines. Behind this sell-off, big institutional money is not simply running away from markets. It is rotating into assets that still benefit from the long-term AI revolution, but carry less valuation risk. And silver sits exactly in that unique position between technology demand and safe haven psychology. In the next part, we will go deep into why silver prices can stay strong or even rise during an AI-driven sell-off, and what hidden market mechanics are pushing capital toward metals. And, at the same time, we will also uncover why Bitcoin is moving in the opposite direction, falling during the same market stress, despite being called digital gold, and how liquidity pressure, leverage, and risk-off sentiment create that powerful divergence. Markets are shifting faster than most investors realize, and while AI stocks are falling, silver is quietly showing strength while Bitcoin struggles. And this is not a coincidence. Right now, a hidden capital rotation is happening behind the scenes, separating real-world assets from high-risk digital trades, and very few people understand what it means. Today, we're breaking down why the same AI sell-off is pushing one asset higher while dragging another down. And the answer may completely change how you see this market. Because when Wall Street moves money during panic, the real story is not who is falling, but who is silently gaining strength. Total worth of losses, $3.3 trillion. Technology and software stocks together lost roughly $1 trillion in market value, reflecting a large repricing of AI-driven growth expectations across major companies and related sectors. Within that broader decline, the AI-specific sector experienced approximately $285 billion in shock losses, driven by rapid sentiment change, concerns about profitability timelines, and heavy institutional selling from crowded positions. The cryptocurrency market saw the largest impact with around $2 trillion in value erased, as risk-off sentiment, leveraged liquidations, and tighter liquidity conditions caused rapid declines across Bitcoin and altcoins. When combining these major areas, the total worth of losses across tech, AI, and crypto markets reaches roughly $3.2 trillion to $3.3 trillion, representing one of the most significant capital readjustments during the current market cycle. It is important to understand that this total loss reflects market capitalization decline rather than physical money disappearing, meaning valuations dropped as investors reassessed risk, growth expectations, and macroeconomic conditions. These trillion-dollar losses highlight a structural capital rotation where investors move away from highly speculative growth assets towards safer, tangible, or fundamentally supported sectors during periods of uncertainty. Bitcoin with AI sell-off collapse. Why Bitcoin falls. When AI stocks begin collapsing, the first thing that changes is market sentiment. Investors move from risk-on mode, where they chase growth and innovation, into risk-off mode, where preserving capital becomes more important than chasing profit. Bitcoin, despite being called digital gold, is still treated by large institutions as a high-risk asset, which means it becomes one of the first assets to be sold when fear enters the market. Another key factor is liquidity pressure. Hedge funds and big traders often hold Bitcoin alongside tech stocks in the same portfolio because both represent growth and future technology themes. When AI positions lose value, funds may face margin pressure or risk limits, forcing them to sell liquid assets quickly to raise cash. Bitcoin trades 24/7 and has deep liquidity, so it becomes an easy asset to exit fast, accelerating price declines. Leverage also plays a huge role. The crypto market uses significant borrowed money through futures and derivatives. During sudden market drops, forced liquidations trigger automatic selling, pushing Bitcoin down faster than traditional assets. This creates a cascade effect where falling prices cause more liquidations, which then push prices even lower. There's also a correlation shift happening. Over the last few years, institutional investors have linked Bitcoin with technology and growth assets rather than pure safe haven assets like gold. So when AI stocks drop sharply, algorithms and institutional strategies often sell Bitcoin at the same time, because they categorize it as part of the same risk basket. Another hidden reason is dollar strength. During market stress, investors move money into the US dollar and treasury bonds for safety. A stronger dollar usually puts pressure on Bitcoin and commodities because global liquidity tightens and speculative assets lose momentum. So the combination is not random. AI sell-off creates risk-off sentiment, liquidity stress, leveraged liquidations, algorithmic selling, and stronger dollar demand, all of which push Bitcoin downward during the same event. Why silver and Bitcoin sometimes move opposite during same sell-off. Silver and Bitcoin sometimes move in opposite directions during the same sell-off. because they are classified differently by institutional investors, even though both attract retail traders. Bitcoin is treated as a high-risk speculative asset, while silver is often viewed as a hybrid between a safe haven metal and an industrial commodity. During risk-off events, large funds reduce exposure to assets with high volatility and leverage, and Bitcoin becomes an easy target because it reacts quickly to liquidity changes. Silver, however, can benefit when capital rotates toward tangible assets that hedge against uncertainty and inflation fears. Another advanced reason is market positioning and derivative structure, where crypto markets experience rapid liquidations due to leveraged trading. Silver markets tend to move more slowly through futures positioning and physical demand expectations, which can create divergence when sudden selling hits Bitcoin first. Industrial demand expectations also influence silver differently because investors may still believe long-term infrastructure growth tied to electrification, renewable energy, and AI hardware will continue despite short-term stock weakness. This narrative supports silver even while tech-related assets like Bitcoin decline under pressure. Algorithmic trading strategies categorize Bitcoin within the technology and growth basket, meaning it often follows NASDAQ-style moves during market stress. Silver, on the other hand, sometimes trades closer to commodities or precious metals depending on macro signals, allowing it to move independently. Another hidden factor is investor psychology, where fear pushes traders toward assets perceived as having intrinsic physical value rather than purely digital speculation. In these moments, silver can attract defensive buying, while Bitcoin experiences faster selling due to risk perception differences. Effects of silver prices during this currently AI sell-off, and why silver looks stronger. The current AI-driven market sell-off is creating one of the most interesting divergences investors have seen in recent years, where silver is showing relative strength, while Bitcoin appears weak under pressure. At first glance, this may seem confusing, because both silver and Bitcoin are often discussed as alternative assets outside traditional financial systems. Yet their behavior during market stress reveals a deeper truth about how institutional capital categorizes risk. When AI stocks begin falling, the first reaction across markets is a shift from risk-taking toward capital preservation. Institutional investors, hedge funds, and algorithmic strategies rapidly reduce exposure to assets considered highly speculative, and Bitcoin falls directly into that category because many large portfolios treat it as a high beta technology asset rather than a pure safe haven. Silver, however, sits in a unique middle ground because it combines the characteristics of a precious metal with real-world industrial demand tied to technology and infrastructure. Another key reason silver appears stronger is capital rotation. During an AI sell-off, investors start questioning high valuations in technology stocks and begin searching for assets that still benefit from long-term technological growth without carrying extreme valuation risk. Silver becomes attractive because it is essential for electrification, renewable energy systems, semiconductor components, and data center infrastructure, all of which remain necessary even if AI company stock prices decline temporarily. Liquidity dynamics also play a major role in this divergence. Bitcoin markets rely heavily on leverage through derivatives and perpetual futures, meaning sudden price drops can trigger forced liquidations that accelerate downward momentum. Silver markets, while volatile, are supported by physical demand expectations and longer-term positioning in futures markets, which can reduce the speed of cascading sell pressure compared to crypto assets. Another important factor is investor psychology during risk-off environments. When uncertainty rises, market participants often prefer assets with tangible physical value rather than purely digital assets perceived as speculative. Silver benefits from this shift because it represents both monetary history and industrial necessity, creating a psychological anchor that can attract defensive flows even when broader markets struggle. The strength of the US dollar during AI sell-offs also contributes to Bitcoin weakness. As investors seek safety in cash and treasury bonds, liquidity tightens globally, reducing speculative appetite and placing pressure on cryptocurrencies. Silver can sometimes resist this pressure better because it is simultaneously supported by commodity demand narratives and expectations of future monetary easing if economic conditions weaken. Algorithmic trading models further reinforce this divergence because many quantitative systems classify Bitcoin alongside technology and growth assets. When AI stocks drop sharply, these strategies may automatically reduce Bitcoin exposure, increasing correlation between crypto and the NASDAQ. Silver, on the other hand, may shift between different market categories depending on macro conditions, sometimes trading like a precious metal, and other times like an industrial commodity, allowing it to decouple from technology sell-offs. Ultimately, the current AI-driven market environment highlights the difference between perceived innovation assets and tangible resources linked to technological infrastructure. Bitcoin weakness reflects its positioning as a risk asset, sensitive to liquidity and leverage, while silver strength reflects its hybrid role as both a hedge and a strategic metal essential for the technological future. Understanding this distinction helps explain why, during the same sell-off, One asset struggles while another finds support, revealing how capital flows reshape market leadership during periods of transition. The current AI-driven sell-off is not simply a market crash. It is a transition in how capital flows between risk assets, tangible commodities, and emerging technologies. Bitcoin's weakness during this phase reflects its positioning as a high-risk, high-liquidity asset that institutions quickly reduce when fear rises, leverage unwinds, and investors shift toward safety. Silver, on the other hand, is showing relative strength because it sits at the intersection of defensive investing and future technological demand, benefiting from both safe haven psychology and its essential role in electrification, energy systems, and AI infrastructure itself. This divergence reveals a deeper truth about modern markets. Not all alternative assets behave the same under pressure, and understanding how institutions classify risk is more important than following popular narratives. While Bitcoin reacts like a technology-driven risk asset during liquidity stress, silver acts as a bridge between traditional monetary protection and the industrial future tied to technological expansion. As the AI sector recalibrates and markets search for stability, silver's hybrid identity may continue attracting strategic capital, while Bitcoin's performance will depend heavily on liquidity conditions and overall risk appetite. The real lesson for investors is that market chaos often hides structural shifts rather than simple panic, and those who understand capital rotation can see opportunities where others only see volatility. If the AI revolution continues long-term, and most indicators suggest it will, then assets connected to real-world infrastructure and monetary hedging may remain resilient even as speculative assets experience deeper cycles of boom and correction. Right now, investors should focus less on reacting emotionally to headlines and more on understanding how capital is rotating during this AI-driven sell-off. Managing risk is essential, so reducing overexposure to highly leveraged or speculative positions while maintaining balanced exposure can help protect capital during volatility. Diversification across different asset classes, including precious metals like silver alongside quality equities and selective crypto exposure, can reduce downside risk while keeping upside potential. Instead of chasing sudden price spikes or reacting to sharp drops, investors should consider gradual accumulation strategies that align with long-term trends rather than short-term noise. Understanding liquidity dynamics is critical because forced selling and margin pressure can create temporary distortions that do not always reflect true market fundamentals. Monitoring macroeconomic signals such as interest rates, dollar strength, and central bank policy helps investors anticipate how silver, Bitcoin, and broader markets may react next. Overall, disciplined positioning, patience, and focusing on structural market shifts rather than emotional reactions remain the smartest approach in the current environment. If this analysis helped you understand what's really happening in the markets, make sure to like the video and subscribe to the channel. We focus on explaining the forces behind market moves, not chasing headlines or hype. Markets will keep changing, but informed investors stay one step ahead. Thanks for watching, and I'll see you in the next breakdown.